Good afternoon, everyone, and thank you for joining us on today's investment update hosted by Alterna Wealth and our partner NEI Investments. I'd like to thank you all for joining us on this afternoon to hear from John Bai and Raffi Wojtal on the recent market events. Talk about a little bit about what's been going on the cryptocurrency side, and certainly provide a market outlook. Obviously, since we last held the previous webinar, a lot seems to have happened. In Ontario, we've had a lockdown that began, I guess it would be 4 weeks ago almost now. And certainly lots of vaccinations. We're starting to see a reopening of the economy in the US. We are also hearing noise around, what is cryptocurrency and Bitcoin. And so I think the discussion today is going to focus around some of these items, and certainly looking forward to hearing what Raffi and John have to say about where this might take us down the road, as we do see our colleagues in the US starting to open up their markets. What does that mean for us? And more importantly, what is the impact that could have on your investments? So a couple of housekeeping items. Everyone will be in a listen-only mode. And certainly we are recording this session. So I wanted to, again, welcome everybody. And with that, I'll pass it over to John or Raffi. I'm not sure who's going first.
Oh, sorry about that, Sean. I'm going to put my video on. I didn't realize it was off, but you'll pass it over to me. And good afternoon, everyone. Thank you so much. And Sean, thank you so much for hosting this. These are important parts of making sure that people are up to date on their investment portfolios and investment outlooks. And we certainly appreciate the opportunity to participate in today's webinar. So with that, what I'm going to do is I'm going to share my screen just to make sure that everyone can see that. Sean, are you able to see that? Okay, perfect. And so with that, what I'm going to do here is let's just go here, our mandatory disclaimer, just to make sure that all of you know. And then what we want to do today is to just go through our market review, what has happened in the markets in the first 3 months of the year, give a quick market outlook in terms of what we are expecting for the rest of the year. Just a reminder of the NEI active portfolio management approach. And as Sean mentioned, we've been getting some questions on cryptocurrency, so we'll definitely address that at the end of our presentation as well. So with that, do a quick market review in terms of performance. So this is market performance for the first 3 months of the year, so January 1st to March 31st. And again, just wanted to leave you with one stat here, just to tell you how incredible the past 12 months have been. Again, that stat is 76%. That is the 1-year rate of return of the S&P 500 since the bottom at March 23rd, 2020. And so March ends an incredible year. And it's the first time since 1936 that you saw a 12-month period on the S&P 500 up over 70%. And as Sean mentioned in his opening comments, there's lots of reasons why there's so much euphoria in the markets. Number one is we point to fiscal stimulus. True to his election promises, President Joe Biden spent his first days in office working and pushing through some very, very large stimulus packages. The 1.9 trillion stimulus package that he pushed through in March, incredibly with not very much what's the word I'm looking for? Compromise with the Republicans. And then he went immediately to work on another 2.25 trillion stimulus package that was announced in the final days of the quarter. All told, the U.S. passed COVID relief and spending bills totaling 25% of their economy over the past 12 months. That's highest in the G7. And so that certainly got the economy going. Faster than expected vaccine rollout. Joe Biden promised 100 million vaccine shots in the first 100 days. We all know on this call that went spectacularly well. We have a bit of vaccine envy for sure. Today now, 40% of the US population has at least one shot, and the economic data is showing a strong economic rebound on that. And then finally, the central banks have reiterated that they plan to keep interest rates low, and with that, to at least 2023. And so all of that, you saw an incredible rotation out of bonds and into stocks. And that quarter was really the pinnacle of a big, big run, 12-month run. And so on here, Canadian bonds, you'll see we're hardest hit on this rotation out of stocks, so out of bonds and into stocks. Bonds were down 5%. Global bonds were down about half that amount, negative 2.5. And of course, the higher risk bonds of high yield bonds were actually positive on the day, on the quarter, due to their higher income and coupons that those bonds generate. Canada did really well on the quarter with driven by our cyclical stocks and financials. And the US markets did okay, but really held back by the tech mega cap stocks that are constrained by rising interest rates. And this has been a big topic of conversation in my household, so we can certainly address that later on in the call if that's what you'd like to do. European equities lagged in the quarter, and this is really continued COVID lockdowns, and their slow rollout of the vaccine is really putting them 6 to 9 months behind the US. The US dollar actually had good strength on the quarter, but relative to Canada, due to high oil prices, the Canadian dollar, the US dollar actually was down negative for us. Just moving on to the fixed income rates, what I'll say here is that, just like we saw an historic run in the equity markets over the last 12 months, we saw a really a almost historic quarter in fixed income. We saw an increase of 10-year treasury yields in the US. They were risen by what we call 83 basis points. That's almost 1%. It's 0.83 of 1%. And that was one of the largest quarterly gains we've seen since the global financial crisis. What you're seeing here is what we call a yield curve. The green line is where interest rates were in December 31st. And at the left-hand part of that chart over here, you'll see that these are interest rates on short-term bonds, and that's really pinned down by, like I said, the low interest rates that are pinned by the central bank, and they're saying they're not moving interest rates on that low end for a long, long time. But you'll see here on the 10-year, on the 20-year, you saw a big rise in that, and we call that a bear steepener as this yield curve got steeper. And that and that really signals, generally speaking, a strengthening economy, and that's what the markets were beginning to price in here. The other big move on why interest rates were moving up was because of interest rates. And on the interest rate forecast, we saw March interest rates rose by 2.5% on a year-over-year basis. But there is some distortion in the inflation numbers. As I said, March of 2020 and April and May of 2020, extreme low bases. And we call this the base effect. Because the year-over-year comparisons are off such low outliers, and this really creates anomalies in the numbers. So, the Federal Reserve, although they are very fixated on interest rates, they are unfazed by this rise of headline risk, just because they realize that it's off a low base, and we expect that. They expect that to be transitory. Whether or not it really is transitory, we'll see. But certainly, we are seeing seeing inflation both in U.S. and Canada rising, and that is that is concerning for the markets, and we'll keep a close eye on that. But most importantly, what happened last year with the Federal Reserve and to some extent Canada, where the central banks said, instead of looking at headline inflation and raising rates in anticipation of them rising over 2%, they're going to look at average inflation. So more of symmetrical rise around 2%. So that's also allowing them to be more patient than they have been in past cycles in terms of their desire to raise interest rates. And so these low interest rates have provided a very strong backdrop for our equities. We saw a really strong rotation into equities, but within the equity markets, we saw a strong rotation out of growth stocks, which have been the stalwart in 2020, and into value stocks. And again, there are a couple of headwinds for technology stocks. They're really seen as defensive stocks for several reasons. Number one, when the economy was closed down and the physical economy was closed down, everyone had to go shopping on the online stores, and that's why you've seen a strong demand for technology. But as the economy begins to open up, there's more economic activity that's in the physical economy and not on the digital economy. And as a result, investors are now beginning to price up, some of these opening up COVID plays, and a lot of those are trading at very low valuations, and we call those value stocks. And so that's why you've seen the outperformance up here of value outperforming growth, which is the green line. On the select portfolio side here, really, I want to say a couple of things. Number one, over the last, well, actually, the last time we did this, we had actually two portfolios, the NAI Select RS portfolios, the NEI non-RS portfolios, and really from our perspective, this is, in April, we did a pretty sizable reorganization where we merged our select portfolios into one franchise, one flagship product instead of two. And so why did we do this? We did this for many reasons, and some of you might have seen that on your statements. And first and foremost, it was really consistent with NEI's strategy to extend our leadership in responsible investing. And so we wanted to make sure that, as we go forward, we want 100% of our lineup to be responsible investing, and merging our select portfolios into one moves us meaningfully towards that goal. The second thing here is that, we want to have the most diversified lineup of RI portfolio building blocks to include in these RS responsible investing portfolios. And so, over the last 3 months, we've been really busy creating 3 portfolio building blocks. Emerging markets have converted from a non-responsible investment strategy to a responsible investment strategy. Our global high yield bonds have moved into a responsible investment mandate, and our global value. And so we've been able to include those into these portfolios, and again are in fact among the first active mutual funds in that category, those categories to be RI. And then finally, just simplifies our lineup, and going forward, you can be assured that we will be focused on providing only the highest expressions of responsible investments for Alterna and their members. And so, just moving to performance that's on the slide, you'll see here that again, in a risk-on last 12 months, these portfolios are behaving exactly as they were designed. That the lower risk portfolios had lower income, and the higher risk and with a higher allocation to equities had much higher rates of return. And in fact, actually for the quarter, 5 of the last 6 select portfolios beat their benchmark. And for instance, on the select balanced portfolio, which is right in the middle, 50-50, we beat our benchmark roughly by 2%. And 70% of that outperformance was driven by our asset allocation decisions, which we'll talk about in a moment. But that basically was that, given our positive views on the economic recovery, we overweighted equities by 5%, and that definitely helped returns. And also manager selection was positive as we had some managers that outperformed their benchmarks as well. In the private portfolios, again, same type of basic rates of return. You'll see that the lower risk portfolios had lower returns, the higher risk portfolios had higher returns. We had a couple of really terrific performances on some of the underlying managers, including our managed asset allocation pool, which beat our benchmark by over 1% in the last quarter. But you'll see that these numbers are slightly lower than the selects, and that's largely because the difference is on the negative side is our AllianceBernstein, our manager for global equities. And they're really a low volatility strategy. And why that's really important is that they believe that buying high quality, stable companies at the right price can beat the market and limit downside risk. And that was really important because we started these portfolios right before a COVID crisis. And when that market was being pulled back so dramatically, it was important that we had managers here that would blunt the fall of those negative losses. And AllianceBernstein worked really well, outperforming the benchmark during that market downturn. But when the markets are up 76%, this low volatility strategy will underperform. And so we did expect it to underperform in these strong rallies. And so we are not concerned. In fact, we're still very confident that this higher quality, lower beta strategy is good for members over the long run. And so the bottom line before we move to our outlook, Sean, is that we continue to actively manage our portfolios. Our portfolios currently have an overweight to equities. On our manager selection side, our value-oriented managers like Canadian equities and global value are outperforming because of their value tilt, and that's exactly how we expect them to perform. So overall, good quarter for the portfolio products. And so with that, what I'm going to do is turn the call over to Raffi Wojtal, who is going to give us, so he is our portfolio manager on the asset allocation side, and he'll give you a quick market outlook, and then we'll open up the call to some questions. And so Raffi, over to you.
Thanks, Sean. Yeah, so I'm just going to go over our outlook for the next 3 to 12 months on the economy, on markets, and how we're positioning the portfolios for that. So just from a high level, we're currently positive and overweight equities, and we expect them to outperform over the next 12 months as the global economies start to reopen and we start to see economies rebound, mainly due to the massive amount of stimulus that's been pumped into the economy. So we're overweight equities and we're also underweight bonds for the same reason. So as the economy opens and people start spending money, we expect inflation to increase, which will put downward pressure on bonds, as well as the economy gets better, the central bank should start getting more hawkish with monetary policy, which should drive rates higher. So our overall view is overweight equity, underweight bonds from a high level. It kind of feels like we've gone through the easy part of the game since March 2020. So now that the economy's recovered, the economic data has kind of bounced back, we're kind of in a prove it mode from the economy. The market wants to see economy keep improving, keep getting better. And so our expectation is for the ride to be a little bumpier from now. So the gains just won't be as easy. Also, a lot of economic statistics have peaked right now. Because of base effects, as John mentioned, there's kind of a distortion in all the economic statistics because they compare to last year. So they all look really, really high right now. And over the summer, they should kind of come down, which the market may kind of interpret that as just a slowing or a consolidation. At the same time, all the stimulus measures have kind of been implemented. I mean, Biden's still putting out additional ones, but the discussion around taxes is also going to be increasing over the next few months. So that might kind of stress out the market. So main point is overweight equity, underweight bonds, and the ride might be a little bumpier for stocks going forward over the next 3 to 12 months. So on this first slide, covering COVID and the vaccine distribution, it's in a weird way, it's kind of a solved issue. We have a vaccine that's effective. It's all coming down to distributing it as fast as possible. That's the main concern. So if we can distribute it as fast as possible, then we can start reopening economies and get back to normal. There is kind of another wave happening in India, especially where they're getting 350,000 cases a day, but the market's kind of looking past that. So one interesting thing is a lot of the vaccinations have been focused on older populations, people over 65. And if you look at the data, people over 65 have had lower hospitalization rates. So the vaccine's working. And the key is to distribute it. And the market's basically saying that that's going to happen over the next few months. So right now we have the US kind of leading, and the expectation is they'll reach herd immunity by the end of the summer and be able to open up. In Canada, we've kind of picked up the pace recently. At the end of March, we only had about 13% of the population had their first shot. At the end of April, we've picked that up to about 33%. So the pace is steepening, which is good. And if that keeps happening, then we can actually open up economies and people can actually go out and live their lives. So COVID, in a sense, is a solved issue. We just got to get the vaccines out. And once we're able to open up economies, because of all these lockdowns and restrictions, people haven't been able to spend. So if we go to the next slide here. So people haven't been able to spend because of lockdowns and restrictions. At the same time, there's been a lot of stimulus put into the economy. So people have saved a lot of cash and not spent. So as the economy opens, the expectation is people are going to go and start spending, and that should drive the economic rebound in the year end. You're kind of already seeing that in the data. If you look at US retail sales, they've already passed the pre-COVID trend. So people are already spending in the US. So that stimulus is going into the economy. So if we just go back one slide here, just to see the size of the amount of stimulus that's been put in the economy. So it's been massive and really incredible to see. So this chart kind of shows what the stimulus has been in COVID by all these different countries compared to the stimulus that was put in 2008. So if you look at the US in 2008 to 2010, stimulus was about 5% of the economy that was put in. This latest round of stimulus, the US is putting almost 25% of spending in the economy. So it's a really big amount that is gonna drive the economic rebound. And that's kind of our view. As the economies open up, this money will flow into the economy, and we should see really positive economic data going into year end. And this is why we're overweight equity, because of this massive stimulus. Also on this point, as I mentioned, the conversation is kind of turning to how we're going to pay for this in taxes. So Biden kind of released his initial plan for his tax increases, and it's really focused also on inequality in the U.S. So he has three major elements of his tax plan, and the first one is to raise the corporate tax rate from 21 to 28%. Number two is more of a global issue. So Janet Yellen mentioned talk of a global tax rate. So they want the whole G20 to set a minimum tax rate so that a lot of tech companies can't take advantage of loopholes where they can pay lower taxes. So for example, companies like Google, they allocate all their intellectual property into places like Ireland, which has a really low tax rate. And then all their global revenue goes there, and it's taxed at a lower rate. So Janet Yellen and the Biden administration are trying to discuss with the G20 to set a minimum tax rate so tech companies mainly can't do this. Canada also introduced in their latest budget a potential 3% tax on revenue for tech companies. So this discussion of taxing tech companies that are avoiding taxes is increasing and may be implemented. The last element of his tax plan is a capital gains tax, so increasing it from 20% to almost 40%. And that would be retroactive to 2021, which basically there's no point of starting to sell now because the capital tax would apply retroactively. So now the discussion is turning to tax, but stimulus has been pumped into the economy, and it will start being spent and show up in the economic data. So if we go to the next slide, the one after this. So on top of all this fiscal stimulus, we also have the Fed, and the Fed has basically said they are not doing anything. They are focused on unemployment. They want to see unemployment reduced. They want to see people in low income areas get jobs, and that's their main focus. And back in August 2020, they've changed their inflation framework. So generally, historically, what the Fed has done, they follow inflation, and when they expect it to hit 2%, which is their target level, they begin to start increasing interest rates. And that's kind of the playbook they followed over the last 10 years, and they haven't been able to achieve 2% inflation consistently. So what they did, now instead of expecting inflation, they actually want to see inflation hit 2% and remain there before they start tightening. So the main point here is the Fed is keeping rates at zero and easy. And this chart shows their latest projections. They're keeping rates, that little blue dot on the right is where they're keeping rates over the next 3 years is their expectation. So until 2023, the Fed is saying no interest rate increases. And it's interesting to see, and you could see their commitment to this new framework, because if you look at 2021, the Fed expects real GDP to hit about 6.5%, and then they expect inflation to hit about 2.5%. So if you combine that on a nominal rate, so how the number you're going to see is GDP, they expect GDP to almost grow at 9% in 2021, and they still aren't going to increase the interest rate. So this adds more fuel and stimulus to the already strong and rebounding economy. So this is another supporting factor for us to remain overweight equities and underweight bonds. So them being easy should push up inflation, which may hurt bonds. And eventually they're going to have to start increasing once the economy is really strong. And that should also push bonds lower. So that kind of leads to both our equity overweight and our bond underweight is the Fed staying incredibly easy. If you go to the next slide, mentioned inflation, John talked about inflation. So this is kind of the main focus right now of the market, the bond market specifically. So interestingly, we've had really strong inflation data, but the bond market hasn't really done anything. It's kind of staying consolidating. So what that's kind of saying is the market is expecting the data come in really high, and the bar is kind of set really high for economic data to surprise to the upside. So we believe that the data will continue to improve. And bond yields should increase over the next 12 months, and that's why we remain underweight. So kind of digging into inflation, right now the main drivers are, as John mentioned, base effects. What that means simply is you're comparing this year's inflation to last year. And since last year we had COVID and we had such low numbers, as those numbers come off, the year-over-year numbers for inflation look really high. So it doesn't necessarily mean the inflation numbers are wrong. It just kind of distorting how we should interpret it. So you want to focus on month-over-month numbers to get a better feel for how inflation is changing. So that's one driver. The other driver is supply chain disruptions. Because of the pandemic, supply chains have been negatively affected. You're seeing that in higher input prices. So these two charts on the left here, Chinese input prices. China's basically the world's manufacturer. Their input prices are going up. That should eventually flow through into headline US inflation numbers. The chart above it shows that that's kind of already happening. So they have these manufacturing surveys where they talk to manufacturers and ask them, is production up? Are prices up? And all of them are reporting that their input prices are going up. So that should lead into inflation. And we're already starting to see that to turn. So the chart on the right shows global inflation data, and you're seeing it start to turn up. So those supply chain issues are flowing through into inflation. Now, kind of the key right now and why the bond market's not really reacting is, will this inflation data or will this input inflation hand off to demand inflation? So once economies open up and people start spending, will that push up final prices as everyone goes out, all that cash that they saved, all the stimulus that's been given out, are they going to spend that and push up prices, the final end product prices? So the market's trying to see if that handoff is happening as the economy opens. And we believe if that happens, then you're going to see inflation numbers continue to go up and bond yields continue to go up. So as I mentioned, that is why we're underweight bonds right now. And just some other interesting stats I'm kind of seeing everywhere. You can see this inflation input inflation is kind of a main word. So one of those manufacturing surveys, the prices paid, their input prices, hit one of the highest readings since the 1970s. So that's one. The other one is just the crazy amount of demand for housing. And I mean, we have that in Canada, but you're also seeing it in the US. So in the US, new home sales and housing starts reached their highest level since 2006, which is right before the housing crisis in 2008. So that's how much demand there is for new housing. And inventories are also low. So because of COVID, people aren't selling their houses. Inventory has fallen to the lowest level since the 1970s in the US. And the last kind of output you're seeing of that is lumber prices. If anyone's following lumber prices, they have gone completely exponential this year because there's so much demand for building new houses. So you're kind of seeing that inflation, that economic demand all over the place. So long story short, we should see inflation increase, and hence why we remain underweight bonds right now. On the next slide here, so from a global perspective, we follow China very closely because they are one of the biggest economies in the world, and they are a main driver of economic activity. So China is pretty much the largest importer and exporter of goods in the world. The IMF expects over the next 5 years, China is going to add about 20% of economic growth. And that growth kind of flows through everywhere. That growth, when China grows, they get higher imports. That improves economies in Europe, like Germany. That improves economies like Japan. Their demand and their growth really picks up global economies. So this is why we closely follow China, because they're a strong source of demand. And we had the recent GDP numbers that came out, and again, base effects is kind of the story. They had a record 18.5% year-over-year increase in GDP, but because of base effects, you got to look quarter over quarter. And this chart here on the left looks at the quarter over quarter increase in Chinese GDP. And it kind of shows that after a huge fourth quarter and first quarter, they're kind of starting to slow. So their latest quarter over quarter GDP increase was 0.6%. And if you compare that to the pre-COVID average, it's pretty low. Pre-COVID, they were increasing about 1.7% quarter over quarter. So our view here is China's starting to slow, and policymakers in China, even pre-COVID, have been focused on reining in credit growth and trying to contain leverage in their economy. So they kind of see this as a chance to reduce credit growth, because the rest of the world's pumping in stimulus. They've just had strong economic growth. They can kind of rein in their leverage. They have an opportunity to do that right now. So there was a story on Bloomberg where the Bank of China was telling banks to limit lending for the rest of the year. And where you're seeing that is this chart on the right. It's this indicator called the credit impulse. And basically what it tracks is the change in credit in China year over year. So if credit's increasing, that means loans are being made, businesses are taking loans, consumers are taking loans, and that drives economic activity. It's a pretty accurate measure for where China's economy should go. As you can see in the chart, it tracks it pretty well. And that credit impulse has started to turn. So the combination of slowing GDP data, policymakers wanting to normalize credit growth, and this credit impulse indicator turning over, we expect China to normalize and slow down into the rest of the year. So that kind of makes us neutral on emerging markets, kind of underweight China, but because global economic growth is going to be so strong, there are still areas in emerging markets where you could take advantage of. So Mexico is one area, Taiwan's another area. So you don't want to just be underweight or short or neutral EM. It's mainly China there, and there are little spots that you could pick out for outperformance in EM. So you just got to be picky in EM, and we still expect economic growth in general to pick up, and which is why we remain generally overweight equity, but neutral to underweight EM because of China. The last slide I want to show here is kind of just how much exuberance there is in the markets. So all this data I presented is very positive, you know, stimulus, vaccine distributions, central banks keeping monetary policy easy. All this news is very positive. So it's really easy to get excited about where markets are going and expecting earnings and profits to take off. But the problem comes in that everybody's thinking the exact same way, right? So if you look at, there's this Bank of America does a global fund manager survey where they ask like 300 fund managers their opinions on a bunch of data. So do they think inflation is going to go up or GDP is going to go up? This chart on the left here shows about 60% of fund managers expect higher above trend growth and above trend inflation. So everybody's expecting higher growth and inflation. And the chart on the right shows you how everyone's positioned. So a lot of people are overweight equity. That's the consensus trade right now. Everybody has allocated to equity. So that kind of comes back to the point I made at the beginning, that the easy gains from March 2020 have kind of been made. Everybody's kind of thinking the same way. Prices, I mean, trees don't grow to the sky. So now it's kind of going to be more of it might be a bit of a bumpier ride as the market interprets data. And we see exactly how strong the economic recovery is. If it beats expectations, then markets can keep rallying. And even if it meets expectations, markets can keep rallying. So the point on this chart is basically, it's really easy to get super bullish and it's really hard to articulate a good bearish thesis right now. Just try not to get complacent given all the positive news. There could be surprises that happen, but in general, we're still overweight equity and underweight bonds.
So Sean, we're at the at the end of our presentation here, I'm going to give you just a couple of quick talking points to sum up, and then we'll open it up to Q&A. And so just here, again, we're very pleased to present here Visa Wealth. On behalf of Visa Wealth Asset Management, Visa Wealth was created 3 years ago. And, we were a $55 billion company when that happened during the COVID. It happened at a very important time during the COVID crisis with that big sharp pullback in the markets. We actually had stronger capital positions as a combined company than we did at the beginning. And we went from 55 to 90 billion, and we're seeing strong growth across all 4 asset lines. NEI continues to, and you've seen some of that process today. We start with our industry-leading responsible investment team on the bottom left-hand side here. And then we go to active management. We hire some of the best external managers globally, and we provide a very rigorous oversight. We now have 17 external managers that collectively manage over $7 trillion of management. So there's strong resources. And we continue to manage the portfolios. And this is a portfolio point that I wanted to make earlier, was that, we try to avoid the sharp up and down of your portfolio and start to get a much smoother ride for you and your members. Because, in retirement, how you get drawdowns in your portfolio can affect how you retire, and the resources you have for retirement. For a conventional portfolio where you see a big downside shift, you can run out of the monies quickly, whereas if you minimize the downside volatility, creates for a much better experience and more stronger portfolio to retire on. And that's why we focus on lower volatility. And then finally, here for us, it's not just about risk and return. What we're finding out is that we can create portfolios that traditionally have been optimized for both risk and return. And that's the way portfolio optimizations happen for decades. But in today's day and market with ESG analytical tools, we can have two portfolios, the exact same risk and return, expected risk and expected return, but one has positive impact, one has measurable positive impact on the environment and on social issues. The other one doesn't. We're finding that investors are increasingly choosing portfolios that are optimized to have positive real-world environmental and social impact. And then with that, we're increasing our commitment by adding additional portfolio building blocks, such as the Environmental Leaders Funds, which again provides an annual report on their positive environmental and social, just in this one, environmental impacts, Global High Yield Bond, as I mentioned, Global Value Bond, and ESG Canadian Index Fund. And finally, Raffi, we're not going to have time to get into this, but we have optimized this through a strategic asset allocation process. This is the efficient frontier, and what you'll see here is that these individual asset classes by themselves have much more volatility. You can go and create with same expected rates of return with much lower volatility by combining these asset classes, which is exactly what we do.
I think we lost John just briefly there. He seems to have cut out.
And so,
there we go.
Yeah, can you hear us? So cryptocurrency.
Yeah, we just lost you there for a second, John, but you're back.
Okay, sorry, that must have been my. Anyways, can you hear me now?
Yes.
Okay, cool. So what we're going to do is address your opening question about cryptocurrency. I know there's a lot of buzz in there, and everyone's asking about cryptocurrency. And so, we don't have a slide here, but I'll tell you, kind of our approach. We do think that cryptocurrency will definitely benefit from this whole transition from a physical economy to a digital economy. We think there's absolutely great use cases for blockchain in general and distributed ledger in terms of being able to track goods across the economy and make sure that they're organic and things of that sort. The most recent cases we're seeing is that the ability to authenticate artwork so that they're original digital artwork. So there's lots of good use cases for blockchain and distributable ledger. But in terms of cryptocurrencies, we are at the early stages. Clearly, we're at the early stages, and you're seeing lots of speculation in the markets, and that's driving up really strong price returns. But it's also driving up big volatility. I think a couple of weekends ago, you saw that Bitcoin was down 15% over the weekend, and that's just one weekend. And so, the final point here for investors is that there's no fundamental way of valuing these cryptocurrencies. We're not experts on them. Is Bitcoin the latest, the most lasting one? Or, over the weekend, we saw news stories that there is a new cryptocurrency, Ether, that is, the new Bitcoin and promises to disrupt Bitcoin and what they do. Whether or not that happens, who knows? We don't know. But for us, we think that, if you're interested in cryptocurrencies, I'd put that in your explore part of your portfolio, not the core part of your portfolio for, everything that I talked about before, that if you want to put retirement portfolios together, best to invest in things that we know and that don't add volatility to that, both on the upside and downside. We invest in what we know. For instance, things such as, if you look one, I'll stop there. So with that, Raffi, I don't know if there's anything you want to add on that crypto question before you move it to real Q&A from Sean.
How much time do I have?
I
can add quite a bit.
2 minutes max.
2 minutes? Okay,
yeah.
That's tight. Okay. Yeah, I would just agree with John that it is, if you're considering it, it should be an exploratory part of your portfolio. There is so many stories all over the place, from it's going to revolutionize currency to it's a complete Ponzi scheme and a scam. That's the range of opinions on Bitcoin. And yeah, it is in its beginning stages. I think you could think of it as like the beginning of internet companies in the 90s. Some will succeed, who knows, in the next few decades, and many will fail, and it's incredibly hard to pick those. So if you are looking at it as an asset, I would think of it as like an option. You put some money in it, and if it expires worthless, then it's gone. But it does have a lot of potential upside. So yeah, that's kind of how I would look at it from an asset allocation framework. So yeah, that's kind of my high level view. In 2 minutes, I'll just stop there.
Oh, and guys, I appreciate those comments on cryptocurrencies, because obviously, we get them in the branches. People come in and they ask us, our members come in and want to know, what our thoughts are on, cryptocurrencies, not so much in the application or future application of cryptocurrencies, but as an investment today. And I think that's where we really need to create that separation, because there is inherent volatility when trying to select whether it's Bitcoin or Ether or many of the other ones that are available today. How do you purchase them? How do you value them? And should they be a part of your investment or retirement portfolio? And certainly, I do agree that the first and foremost is to create a strong risk-adjusted portfolio for your retirement savings. If you have some risk capital where you're comfortable in riding that roller coaster, maybe then you would sort of dip your toe into the cryptocurrency space. But I did want to go back and to a couple of comments that were made, and thank you both for your time. Obviously, in the presentation, there was the talk about, do we underweight certain areas and overweight areas such as equities? And I think the message to our members is when you're purchasing or investing in an NEI portfolio, it's actually the management and the portfolio managers and the folks like John and Raffi that are behind the scenes that are making those adjustments for you. So you're not thinking, do I need to buy a certain fund or readjust my allocation to this fund? They're providing you a bit of the background information of the work that goes into what they're doing to create that risk-adjusted return, minimize that volatility, and create the best opportunities for you and your growth. Would that be correct to say, John?
Yeah, absolutely. And, one of the things that we hope you get from this webinar is the fact that, we are watching these developments very, very closely. We as a portfolio management team meet on a daily basis, if you can believe it, to talk about movements in the markets and whether or not these portfolios are positioned properly. We do a detailed review of these portfolios on a weekly basis to ensure that they are properly positioned. and that we're optimizing for risk and return. We tried to show some of that insight in today's webinar, but absolutely, Sean, that we take our responsibilities very, very seriously, and we focus all of that work on these portfolios.
Yeah, and one of the things I got out of it is that I won't be buying any lumber anytime soon to build a deck in our backyard because lumber prices have skyrocketed. But related to that, I did want to ask a question around the housing market, because we are seeing certainly inflated real estate prices in Ontario, where the majority of our membership is. And if interest rates remain low, we're seeing sort of the demand effect in the limited supply. Some of the questions that we receive is, do we feel that we would go back to some sort of house? Are we in a housing bubble? And would we go back to a point where, the market can potentially collapse? Because to be honest, it's getting pretty pricey out there.
Oh, it's pricey and scary. Absolutely. So Sean, Raffi put together some comments earlier, what was happening in the United States. I thought that, I had throw up here. Can you see this chart, Sean? Yeah.
Yes.
So maybe what I'll do is I'll blow it up. Ooh, a bit too much. So this is the Canadian situation, and this yellow line here is this yellow line is it's demand for housing according to the MLS service here in Canada, and this blue line is the inventory of new homes, and so you'll see a massive gap, historic gap. So again, pricing is a function of demand and supply. We're seeing a huge demand for housing, and really housing demand has changed, right? Because gone are the days when everyone wanted those tiny condos downtown Toronto, and 400 square feet would cost you an arm and a leg, and obviously with COVID and things of that sort, people are moving out of the multi-family homes into the single family homes, and out of the city cores and into the suburbs. But really, the thing that that this is driving is like you said, 17% in February 2021 year-over-year levels. That's 3 times the rate of increases in housing before the COVID bubble. And these are all Canadian numbers. And so really the question becomes now, in terms of housing, and are we in a bubble? And time will tell whether or not we're in a bubble, but certainly on a price to income level, housing is at extremely historically high levels. Canada, if you put us amongst the G7, we would have the highest or among the highest in terms of housing prices to income, as well as debt of the consumer side. So the one thing that I would warn everyone on this call is the fact that if you look at the Bank of Canada surveys, and they asked this question on what are the expectations of consumers for housing prices on a go-forward basis, and expectations for housing prices to continue to increase from these levels are continue to grow. And that's just what that's a natural economic bias, what we call recency bias, that recent trends we just project that into the future. But those of us who've been in the markets for a long time can tell you that that there are times when housing prices don't go up, and so we need to make sure that that if we are buying housing for family members or friends, that we do so in a way that is not untoward in terms of debt, and that they can withstand if the market property, and this is the problem that you saw in the States, they bought houses that they couldn't afford, and then when interest rates went up, they had to sell their houses, and that supply of houses created broke the bubble, and that's when everything came crashing down. So are we expecting a housing crash? No. But the Bank of Canada is certainly cognizant of the fact that their low interest rates are putting upward demand on housing prices on the margin. And so this is why you're starting to see policy from governments, for instance, speculators in the markets, to tax them on a more aggressive basis. And I think on the margin, that's all good. But at the end of the day, we would just go back to financial planning 101. In terms of housing pricing, which is making sure that you don't buy more than you can afford. Can you withhold? Can you survive if interest rates were to go up? And finally, if the housing markets were to correct by 10, 15%, would you in your household be able to withstand that and see through that? So, these are all important questions, and I think it's very prudent here, particularly after the strong run we see, to make sure that that you and your family and your loved ones and your friends are subject to those rules.
No, yeah, I think you're absolutely correct. I mean, the home, the real estate asset is generally the largest asset that an individual carries or has. And so, you want to incorporate that into your, how does that fit into your financial plan? If you're going to, think about the equity in your home, think about even leveraging some of that equity. And what I would say to our folks on the call is that, you really want to ensure that you have your financial plan and that you continue to revisit your financial plan. I would suggest, reaching out to an Alterna Wealth advisor. You can send an email to wealth@alterna.ca. And if you have questions, certainly related to this call or anything else on financial planning or investments, again, wealth@alterna.ca. I wanted to thank our guest speakers, Raffi and John, for the presentation, for the insights. We do this on a quarterly basis, and our next webinar will be a tax-related webinar happening in June, so watch out for the invitation for that. Once again, I hope that everyone stays safe and is getting through the current situation that we have with the lockdowns in Ontario, and we certainly hope to see you at some point down the road in person. Stay safe, everyone, and this concludes our webinar. Thank you.
Thank you. Bye-bye.
Thank you.